It's time for the Trading Stocks Made Easy podcast. Each week, Trading Stocks Made Easy demystifies stock trading and investing so you can profit big. And now, here's the host of Trading Stocks Made Easy, the wealthy investor, Tyrone Jackson.
Oh, wait, that's the mic. Is it live? It's live? Oh, 3, 2. Well, hello, everybody. It's Tyrone Jackson. Welcome back to another episode of Trading Stocks Made Easy. We thought we'd have a little behind-the-scenes fun here today. All right, today I want to talk to you about stocks that you are familiar with. I think rather than saying that, I probably want to start the show with brands that you're familiar with, because today's episode is called What's in a Name? What's in a Name? And the reason I wanted to do this show today is because there are a lot of people that say when you invest money in the stock market, you should set it and forget it. In other words, buy the stock and don't look back for 2 or 3 years and see how high it is then. And that is an approach that absolutely does not work. And here's why. Because our world, particularly if you're investing in a technology company, our world is changing tremendously, right? So the company that's the hot technology of today, basically by next Tuesday, there's another company that's publicly traded that's doing even better things. In other words, you've heard of the saying, here today, gone tomorrow. Well, when you're buying tech stocks, here today, gone today. Right? So there's another saying that used to be very prominent on Wall Street, which was first in wins. The person to first develop the cloud will win. Well, that is not true at all. Technology is a very risky affair. Now, how do you reduce your risk if you're investing in tech stocks? Well, you have to follow the fundamentals, and you hear me talk about that all the time. That's the top line revenue that is released every single quarter. So 3 tech names I wanted to talk about today, and when I realized I was preparing for the show, I realized almost every company is a technology company these days. If they sell something online, right, direct to consumer, that's e-commerce. So it's hard not to think about any brand as not having a technical aspect to it. But I wanted to start out with an S&P component. This is a company called Tesla, whose shares were trading 5 years ago, listen to this, at $22.50. And at the time of this recording, they're trading at $219. How about that? $22,000 invested 5 years ago is worth over $219,000. Not bad. Well, I can't tell you whether to buy, sell, or hold Tesla, but what are the risks associated with this company? Well, the first thing is the CEO, right? Elon. He's been known to be very erratic and not follow the rules, although he's also been known to be a genius. So he's built this company in a very competitive space, which is the auto manufacturing business. You need a lot of relationships and a lot of money behind you just to get your invention to showrooms around the country so that people can experience this unique automobile. And he's been enormously successful at doing that. And he's controlled the costs, right? So people love the Tesla. They have a buy and sell program, so you can always get the latest model. And the public around the world has taken to this product. So does that mean that you should run out and buy shares? Not necessarily, only if you understand how the company actually generates that top line revenue. Well, every quarter, they've been selling more and more Teslas around the world. So the revenue has been rising. The risk of owning these shares is at some point the company tops out on the amount of new cars that they're selling. In other words, in the auto business, all roads lead to more sales, right? Once your auto company like Ford or Chrysler has its established audience base, if you will, you're not really going to sell more automobiles. You're just going to sell them at a higher price so that you drive up your revenue. Now, Tesla estimates that it still has running room. In other words, 30-40% more people in the U.S. will own a Tesla over the next 5 years, which would feed the top line revenue and cause the stock price to go higher. Do you get it? Right. So there's still running room. If Tesla were to hit its estimates about how many people will own their cars in the future, then guess what's going to happen? The revenue is going to grow and the stock price is going to go higher. So if you only had $5,000 to invest, should you invest in Tesla? Now, there are varying views on what to do with your investment dollars, but I would say no, because that's speculation. You need to take that $5,000 and at least invest $500 10 times in stable companies that have already made it, or maybe invest that money 9 times in stable Dow stocks that pay a dividend, and maybe $500 in Tesla. And if Tesla continues to go up from there, you add more money to your investment. As you know, we refer to this process as building a position. What I see a lot of people do, and this is why a lot of people say the stock market doesn't work, they take one facet of money that they have and they put it at risk in the biggest names in the stock market. And if those names don't have a great 2 to 5 year period, you basically wasted your investment dollars. Okay? So I think Tesla, a little too risky for the people who listen to this show, only because you want to start out with a company like Microsoft or Apple that's proven themselves over the time, pays a dividend, and is also a member of the Dow Jones Industrial Average or the S&P 500, right? So just because you recognize the name of a brand doesn't mean that it's a great investment for you. Tesla, for most of the people listening to the show, a little too high risk at $219 a share. Then there's a name that I'm sure you will recognize, and the only question is, should you be investing in this company? And it's, of course, AT&T. Now, just to put it in some perspective, AT&T 5 years ago was trading at $29.42. Right now, 5 years later, the shares are sitting pretty at $15.27. But Tyrone, hold on. It's AT&T. Of course these shares are going to go higher. Well, they haven't gone higher over the last 5 years. Why? Because this giant brand has caused some missteps. What do I mean by that? They made some investments, big investments, that just didn't work out. Does anybody remember when AT&T bought DirecTV? Right. And what happened? People started dropping their cable because they wanted to stream their programming. So if you buy a business and the consumer starts to, cancel their subscriptions, which causes the revenue to fall, your integration of your technology into cable programming did not work. See, the DirecTV deal allowed AT&T to, in essence, be in the advertising business. In other words, as long as people were advertising on DirecTV, AT&T was taking in billions and billions and billions of dollars. Plus, they had the opportunity to run their brand across DirecTV with little or no advertising. So it all seemed to work out. We see this a lot when entertainment companies take over technology companies or technology companies take over entertainment. Like, for example, Disney owns ESPN and the ABC television network. In all of the unsold ad space, what can they put in there? Well, ads for Disney, of course, or promote Disney programming. So sometimes that strategy actually works when you buy a broadcast, or in the case of DirecTV, a cable outfit, but it did not work out for AT&T. So the name is popular. It's had a great history over the past 60 years, but is it time to buy the shares while they're down at $15? Probably not. So they're looking to unload some of their assets to build back up the AT&T brand. So just because you recognize the name of a brand doesn't mean it's worth investing in. Back in a moment.
Want to increase your stock market trading profits? Then you need to start your monthly membership to WITradeschool.com right now. Don't understand how to write covered calls for monthly income? No problem. Simply review Tyrone's latest stock trades in our video library as many times as you need. WITradeschool.com is all about helping you get the financial education you need to earn money in the stock market and change your financial life. Tyrone Jackson, the wealthy investor, has helped his students earn thousands of dollars per month trading stocks online from home. These are people just like you. So what are you waiting for? Follow Tyrone Jackson's Red Hot Stock Trades and Investment Strategies today. Don't wait. Start your monthly membership at WITradeschool.com right now.
So should you be investing your money in a brand just because you recognize the name? No. So if I said the name Costco, now many of you are students of mine and you know already how I feel about Costco. I think Costco is a great investment. Why? Because I understand how they generate top-line revenue. First of all, any company that charges you a fee up front and they're charging 200, 300, 400 million people just to shop there is all right with me. Why? Because they have a guaranteed income source. Over the last 5 years, Costco shares have gone from $237 to where they sit right now. You want to take a guess? Yes? 3, 2, $565 per share. And they have a beautiful dividend. But you know what? That company is very smartly run because they buy in bulk and then they resell to the consumer. Now, it's not only that they buy in bulk, it's also that Costco has a beautiful logistics system. Next time you're shopping at your local Costco, you'll notice that there are some price points that appear with more frequency. In other words, there are more $39.95 items than anything else. There are $55.95 items, and there are $69.95 items. When you're shopping at Costco, notice you don't see a lot of wild prices. There's only like 7 prices. Okay, one of the reasons that pricing is laid out like that, so Costco instantly can measure through data what price point their audience is buying this month more than anything else. Hey, we sold more things at $49.95. Our audience seems to like that price more than anything else. We sold a little bit less at $79.95. Hey, look at what we did at $99.95. And $29.95 behaved predictably. See, they can put that data instantly into their system. Based on the economy, they know what to lower and raise the price on based on how many units are actually sold. Do you get it? Costco, to compete, also started its own brand name stuff. So if they have Clorox, for example, in their stores, they know that their brand will sit right next to the Clorox brand and cost a little bit less. You see, they're very good at logistics and how they present their products and their brands, and they slowly raise that annual membership fee. Therefore, they're poised for their revenues to rise. You see, I have a saying when you're an investor, don't buy the stock if you don't understand the story. You have to understand the story before you can consider it as an investment. So I'm going to do a quick little round robin here just to show you, because I study the market every single day. I know I will never own airline stocks. Why? Because what's the biggest expense at the airlines? Fuel. And the airlines don't control the fuel costs. That means the price of your particular seat on a plane is based on how much that airline paid for fuel, right? And I don't like that variable because the airlines can't control the fuel cost. Do you get that? Okay, so I don't like that sector. Semiconductors. Now, semiconductors are components that go inside phones and computers and televisions and all that. That's great. That sector is usually on the cutting edge of innovation. However, those stocks are extremely volatile. They can move up and down $5, $6, $7 per day based on any kind of news that actually comes out. That volatility typically is not what I'm looking for when I'm trading. And it's definitely not what I'm looking for when I'm investing. So semiconductors, I'm not a big fan of them from holding the shares or trading the shares. Then there's a brand name, which I've talked about on the show a lot. I love Macy's. I love shopping at Macy's. I've now developed ways in which I could do it online to get everything from sheets to clothes to shirts to ties. And I love their e-commerce vehicle. However, to have that e-commerce infrastructure up there costs Macy's a lot of money. They're also stuck with the real estate of all of those stores that they have around the United States. And guess what? The stock has been coming down for the last 6 months. So there's a product that I like, but would I invest in the stock? Probably not. Why? Because they need to change their infrastructure, where they buy their products from, their distribution model, and unfortunately, they're competing with Amazon. You can get everything at a reduced price, right? So how long will they be around? I don't know. I hope they never cancel the Macy's Thanksgiving Day Parade, because I am from New York and I used to go every year up into my teens. So I can't let that sentiment for the brand persuade me as an investor. The company must have top-line revenue growth. It must have a good relationship with its partners, its infrastructure, and be able to sell online these days, because every brand is, in fact, a technology company. So think about the stocks that you own, the companies that you like. Do you know how to research them to make sure that you're not wasting your investment dollars? Because there's no such thing as set it and forget it in the world of technologies. You have to be paying attention. So remember that as you're trading and investing in the stock market. Now, I want you to get wealthy sooner rather than later. So, of course, I'm going to endorse my own approach to stocks and building a position and making sure that most of your money is in the S&P and in the Dow Jones Industrial Average, right? So I am here for you to be that guide. Well, that'll do it today. What's in a brand? Well, all that glitters is not always gold. Do your research. In order to do that, you need a financial education. Hey, this is Tyrone Jackson from thewealthyinvestor.net saying, stay positive, stay open. The best thing in your life financially is yet to come. See you right here on the next Trading Stocks Made Easy.
You've been listening to the Trading Stocks Made Easy podcast. Be sure to rate and review our show on iTunes. While you're on iTunes, be sure to click the subscribe button and you'll automatically receive our next episode.